Hello, Real Estate Leadership and Legacy podcast listeners. It's Alex Powell here, and I am really excited to share this next episode with you guys. We have Neal Bawa on, and he is considered the mad scientist of real estate. Honestly, I'm a bit of a data nerd myself, so I'm so excited to share the insights that he shared with us and just talk real estate from a more data standpoint. So I hope you guys enjoy the episode. Hello, ladies and gentlemen. It's Alex here with the Real Estate Leadership and Legacy podcast. And today I am super honored to have Neal Bawa joining us. Neal, how are you doing today?
Fantastic. How are you, Alex?
Very good, very good. I was just telling Neal as well, I'm a huge fan of Neal, and I'm super honored that you would take some time to talk to our viewers and share some of your insights. And it would be my pleasure to kind of introduce you right now. So to give you guys an idea who Neal is Neal is a technologist who is universally known in the real estate circles as the Mad Scientist of Multifamily, which is a really awesome name, by the way. Besides being one of the most in-demand speakers in commercial real estate, Neal is a data guru, a process freak, and an outsourcing expert. And it definitely ties in nicely. I'm an engineer by trade as well, but it ties into my nerd-ness, I guess, as well. Neal treats his $700 million multifamily portfolio as an ongoing experiment in efficiency and optimization. And the mad scientist lives by two mantras. The first mantra is that we can only manage what we can measure. And his second is that data beats gut feel by a million miles. These mantras and a dozen other disruptive beliefs drive profit for his 1,000 plus investors. Incredibly impressive. Well done. So starting us off, Neal, do you mind telling everybody how did you get started into this business?
Sure. So I'm a technologist, computer science degree, data science background. Ran a technology company from 1999 to 2013, about 14 years, grew it from 10 people to 400 people, sold it to a private equity firm in 2013. And as the company was growing, my salary was growing. I live in California. I have the big fat tech salary. And so I was paying 50% of my salary to the IRS. And in 2003, when our senior partner asked us to build a campus, an office campus for the company, I realized the benefits of depreciation after that campus was built. And I realized, oh my God, it is not what you make, it is what you keep. And that changed my path. That got me interested in real estate because I realized real estate had extraordinarily, ridiculously amazing tax benefits. And so over the following 5 years, as my take-home income grew, I was able to make that investments into real estate. So the first decade of my investment into real estate was building campuses for the company, buying lots of single family to fourplex properties throughout the United States, and publishing loads and loads of data science on real estate before I ever took a single investor's money. The second decade has been basically professional investing with 1,000 investors. But the first decade was a lot of fun because that's when I was publishing data and going to conferences and doing stuff and still had no real estate products or services to offer.
Yeah. One of my favorite videos that you've done. I've checked out a whole bunch of your content, and it's, if you guys haven't, check out Neal on YouTube. He's got some very impressive stuff. I think the title of it, I just wrote it down here. How to analyze a real estate market, and then the 10 real focuses. I think for the average real estate investor, anybody, whether you're big or small, checking out the fundamentals is so critical. So before we even get into kind of the projects you're working on now, I want to spend a big chunk of time here talking about the data and the analytics, because we hear a lot of noise in the industry, whether it's with regards to interest rates, political differences. How did you get to start learning more about deciphering what's behind the curtain, I guess?
By asking questions. I think that I find fundamentally that real estate people, both individual investors as well as general partners in bigger projects, are quite good with math, but quite awful with data science. Now, these may seem like the same thing. They're not. People are very good at underwriting a particular single family property or a multifamily property and analyzing and underwriting it well. They're pretty good at that. In fact, I think that there's lots of tools available, Excel tools as well as website tools available for that. And they do a good job. But data science is not about underwriting a particular property. Data science is about um, understanding millions of different properties in the United States and 323 different metros in the United States and being able to compare them at any given point of time for a wide variety of metrics so that you can optimize your profits. 99% of all investors in the United States, both limited partners, general partners, big and small, if you ask them this simple question, what is the best market in the United States today, would not be able to give you a good answer. In fact, the answers generally are just complete bullshit, right? Because they're like, they will say, they will attempt to say things that may make sense to you. For example, they will say, well, I think Austin is the fastest growing market in the United States. That happens to be true, right? Most of the time, not this year, but most of the time. They will say things like Texas is the fastest growing state in the union. Also not true this year, but in general, that's true. But they're not answering my question. They're simply spouting a bunch of public data. A best market in the United States obviously changes over time as the cycle of that particular market changes. And also, the best market in the United States doesn't necessarily have anything to do with which state is growing the fastest, right? You can have a market right now, the best markets in the United States, they're in the Rust Belt, which is the slowest growing portion of the United States. And there's multiple reasons we can get into why it is that the Rust Belt is better today than the Southeast, which grows the fastest. But the point is, at no point must we assume that simply because somebody is investing in some market, it happens to be the best, or even it happens to be in the top 5. In fact, many markets that I am investing in today are actually not in the top 5 in my own list today. Why? Because I've already made investments in the last year or two, and then those markets have moved down. And so my answer is, when I made the investments, they were in the top 5, right? So that's my defense, and I think it's a credible defense. But most people actually have never even tried to rank all of the markets in the United States. That's data science, right? So I can actually give you, people can walk up to me and say, can you compare Burlington, Vermont, a very tiny market, with Idaho Falls, Idaho, another tiny market? Both are very tiny markets. And I would be able to do a very good job of comparing these two markets and even comparing them to some larger market that you pick. I don't believe that anyone else in real estate is doing that because they're not data scientists. They understand their market and they know how to get profit in it. So I think that, and there's nothing wrong there. These people are obviously clearly making money. They know what they're doing. Point is, what they're never able to say is, I know which are the best markets. I know which are the most profitable, because they don't even try. And my company's goal is every single month to rank every single market in the United States, right? And that way, we have a feeling of which markets are going up and which markets are going down. By the way, if a market shows up at number 1, we don't react. We want it not to show up at number 1. We want it to stay in the top 5% every month, because stuff happens. Somebody opened a big Amazon warehouse or opened a big, place, jobs went up like crazy, which, resulted in incomes, which resulted in home prices going up. Fluctuations happen all the time. We pay no attention to it. What we are looking for is, to us, a market that was ranked 300, which is at the bottom of our list, and then was 200, and then was 100, and then was 50, and then was 25. That market is better than a market that's actually already at 25 for a long time, and people have known about it as a great market, and so all the investments that's happened, all the profits being squeezed out. So a market that has momentum and is moving to the top, but is doing it very consistently for all the right reasons, is actually a much better market than the market that's at the top. Because what if the market at the top, everyone knows its story? Well, then you can't make that money, right? Match this to stocks. The stocks at the very top, the Magnificent Seven, a lot of the profit is being squeezed out. Everyone knows that these are the 7 best stocks in America, which is why they're not very profitable. They're safe. They're good investments, but they're not profitable investments. And so my focus is different. I use data science to rank cities. I use data science to rank properties. I don't see anyone else doing that. I'm completely not BSing what other people do. Clearly, they know how to make money. But I think that when people say that they are data driven, that's wrong. So I think there are many different ways of doing things. The process that we follow is the data science process, and it's not perfect. I respect what everyone else is doing. It's just we have our own niche, and the investors that understand how data science is different from math, they're the ones that connect with us. They're the ones that invest with us.
Yeah, I do think like, even here locally, we're in Canada, Ontario, which I'd like your opinion on after as well. But I find a lot of us tend to chase the deal more than we do chase the location, and I think it's easy to forget that real estate is a big part, location, location, location. Of course, you're still looking for the right deal. However, real estate it has often, if you buy it in the right location, has traditionally been a safer investment because even if you buy it wrong, over time the market tends to correct itself. So with the properties that you're like, I'm actually curious, and for the viewers too, what falls into the top five right now in terms of location?
So in the United States, the current top markets are all smaller markets, and there's a lot of good reasons for that. But the straightforward reason is the big markets have risen so much that even with small declines in markets like Austin, they still are not anywhere near the top. So there's markets like small markets, ultra small markets like Burlington, Vermont are at the top. Idaho Falls in Idaho is at the top. Northwest Arkansas is a phenomenal market. It is basically the cities uh, Rogers and Fayetteville. Basically, it's a 500,000 person metro with 4 or 5 cities in it. Springdale. So those are great markets to be investing in at this point of time. Kansas City and Indianapolis, these are traditional Rust Belt markets. They're doing well. All three markets in Oklahoma are doing well. So Oklahoma's doing well. Tulsa's doing well. I can't remember what the third market is. So a lot of Rust Belt markets that are shining at this point of time, and the reason is they didn't have such a crazy increase that we saw before, and most importantly, they are not seeing a huge amount of new supply come in. As you can imagine, it doesn't matter if you're a single family landlord or multifamily landlord, if there's a very large supply of incoming apartments coming in, it's going to affect your rents. You may not understand how it's affecting it, but it's going to affect it because there's just more inventory. There's more choices for people. And people who might go to your single family home, all of a sudden they see this beautiful apartment complex with 3 months of free rent, and they're like, oh, I get all these amenities. I'm going to just go live in an apartment. So, Class A apartments can easily compete with single family homes and can often be cheaper than living in a single family home. So we are seeing a large amount of inventory come into markets in the Southeast. And so they've basically all moved down in our chart. Austin's a perfect example. 3 years ago, it was, easily number one in our list. Rents have fallen by 6%. Home prices have also declined a little bit, a tiny amount. But most importantly, the Austin market's just not hot anymore. That hot anymore. Homes are staying on the market a lot longer, and that impact is because there's such a huge amount of new supply coming in, both for single family and multifamily into that market space. So here's what I would say. If I had an unlimited amount of money and I didn't need to take debt, I would invest. The best market that I would invest in today is still Austin and then Dallas, right? But if I was using other people's money and I was using debt, I wouldn't invest in those two markets right now simply because of the huge amount of inventory coming in. So, what's fundamentally the best market versus what's good for the next 4 years is often extraordinarily different.
Hmm. I heard in one of your talks you had mentioned Utah as being a good place to invest. Have you explored Utah personally and bought out there?
Well, yeah, my destiny is tied to Utah. So I have an incredible amount of projects, both past and present in Utah. So starting from the southern tip, I have an apartment complex that I built. It's fully leased up, 98% occupied. That is in St. George. Moving up, Springville, which is at the southern edge of, the Salt Lake City Provo metro. In 2016, I started building a mixed-use property. Of course, as you can imagine, it's been occupied for a long time. And then next moving up is Provo, which is one of the best cities in the U.S. to invest in, by the way. It is the southern edge of what is known as Silicon Slopes. It's a terrific market to invest in. Provo has the trifecta. I look for trifectas. Provo's trifecta is it has amazing universities, so UVU and BYU are both in Provo. It has technology. It is the southern edge of Silicon Slopes. And then the third thing is It has world-class skiing 20 minutes away. Now that third part brings a smile to everyone, just like it did to your face, but it matters because people come there for college. Then they get into the tech industry and start making a lot of money, and then they can't leave because they're used to going to the slopes, right? So that last part is very important because as these people get wealthier and wealthier, they start buying these ski homes that are in, places like Park City, and then they're tied to that area forever for life because even their ski home is in the is in the Salt Lake area. So I think Provo is a phenomenal market. It's a bit expensive right now. Um, moving up Salt Lake City, I have a property that I've exited, a multifamily property, did well. And then north of that is Woods Cross, which is 20 miles north of Salt Lake City. I have an industrial property, 98% occupied. And then north of that is Idaho Falls, which technically isn't in Utah, but if you understand the Mormon culture, Idaho Falls is more Utah than Idaho. So I love that market. I think of all those markets that I just mentioned, Idaho Falls is probably the best. I think I would say it's definitely the best. Um, and I like all of the others. St. George is a terrific market as well because Utah's become a very rich state in the last 10 years. They've been ranked in the last 10 years in the top 3 states in terms of growth in the US almost every single year. Not every year, but almost every single year. And many years they were number one. So as a result, the state's become very rich, and the state only has one city that is warm, and that's St. George. So when you live in Utah and you want to buy a second home, St. George is a natural pick, right? Because it's 2.5 hours away. You can get on a plane and be there in 30 minutes, and it's very, very nice and warm. So if you have one warm water port, I know it's not a port, that's where the money tends to flow to. So a very large percentage of the homes in St. George are second homes.
For my own curiosity, what do you think of? So we've bought in Columbus, Ohio, and we've done some flips out there. But what's your opinion on like the cities that share kind of Lake Erie, I'd say? So if you're looking through Detroit down into Toledo, through Cleveland up to Buffalo, kind of hugging that. What do you think of like this Midwest, right? What do you think?
Well, I have never seen a pattern of, cities doing well simply because they're positioned near Lake Erie. So here's what I'm going to say, right?
Oh, nothing to do with Lake Erie. I'm just saying the ones that are located there because they border.
Yeah, locations in that area, right? So in general, those areas are actually doing quite well. So, I think that there's a lot of demand there. Supply is not enough simply because nobody's really been building much in that area for a long time. So what's happening is the lack of supply, the lack of construction means that all of those areas are doing well. I will point out that there's a warning that goes with this. So I think that's a good area to invest in, but be aware of this. It is one of my rather disruptive and unpopular beliefs that Chicago and Cook County are America's largest Ponzi scheme. So Cook County borrows money to pay the interest on existing bonds. No one should do that. Cities are allowed to do that, and they should not be. But there's no laws against it. But anytime you are taking in new money to pay interest on old money, that is considered a Ponzi scheme. And so Chicago is not a city. Chicago is a regional economy. It is a $500 billion regional economy. And I believe that it only has three outcomes: bankruptcy in a year, bankruptcy in 2 years, and bankruptcy in 3 years. Those are the three possible outcomes for Chicago. When that happens, the entire area would get hit. So Michigan, Indiana, Wisconsin, the Milwaukee, all of those economies, regional economies, are going to take a very big hit because they're all very heavily tied back. So I think that is the challenge with that area, and that's why I don't invest there. But otherwise, the fundamentals look really good.
Yeah, when I went through your kind of 10-step process, actually, I was looking at it, and Cleveland is one that would be so, from a location standpoint, very convenient. And you think of Cleveland as this boisterous city at one point in time, and you just see people leaving in droves. And I think that population is probably whether the increase or decrease in population is probably one of the most indicative factors of real estate. And people are obviously migrating or leave whatever uh, due to all the other factors, right? If it's not worth living there, we're seeing it actually.
Well, there's other more attractive states, right? So one of the coolest things that I like to show people as the power of data science, which is really easy, is I like to ask people to go open a browser and type in the words Columbus, Ohio population or population space Columbus, Ohio, and Google gives you a very nice map. And on that map, you see three lines, Columbus, Cleveland, and Cincinnati. So they're all, three cities in Ohio. You don't get to see the fourth city, which is Dayton, but you get to see these three. And what is fascinating in this graph, there are two interesting things to point out. Columbus continuously gains population. Cincinnati is flat, and Cleveland continuously drops population. But here's the coolest thing to see. Every time there is a recession, there is a drop in Cleveland's population and an exact increase in Columbus's population. So one should be wary of cities where people leave during recession. That doesn't happen to Cincinnati. You'll notice it's a straight line. People who like Cincinnati stay in Cincinnati, good, bad, ugly, they're there and they're there for life. So it's flat, right? I'd much rather take that flatness than go to Cleveland because every time there's a recession, you see that jagged drop in the line and you see that increase in Columbus. Well, people are fleeing to Columbus because they understand that Columbus as a quality of city, both for healthcare, jobs, technology, and education, is significantly better at this point of time than Cleveland. And so that's why I don't invest in Cleveland. There are many, mathematically speaking, there are very, very profitable projects in Cleveland, more so than Columbus. But I worry about what happens if we get an extended recession. And that's why I don't invest in Cleveland. So once again, I often walk away from the most profitable projects. People have asked me, what are the ones, in isolation, what are some of the most profitable cities in America? And Cleveland's at the top, right? So are suburbs of Detroit, not necessarily inside Detroit. I think that evolution's already happened, but suburbs of Detroit are also quite profitable. But I always worry about, we're leveraging our economy with such an astonishing amount of debt at such an accelerated pace that sooner or later, even the United States, which appears to only be lucky, lucky, and lucky, well, our luck will run out, right? And when it does, I don't want to be in Cleveland.
Yeah, no, I love that. Honestly, it's yeah, I learned real estate from like the Robert Kiyosaki mantras, and you invest in cash flow, you invest for long-term wealth, generated passive income. So I see the draws too from like Detroit. For me to drive to Detroit, it's 3 hours. For me to drive to Cleveland, it's 4.5 hours from where I am here in Hamilton, Ontario. However, it's like we haven't done that because Columbus, for example, is another 2 hours down the street, I guess. But you can see that there's some economic life happening there. My best friend actually lives in Cleveland, became a lawyer, and moved to Columbus. Was an Ohio State graduate. I was curious about your opinion on Canada and Ontario because we have some massive inflationary property value issues, especially in Ontario, British Columbia. Do you ever do any of your data mining in, north of the border, I guess?
I do not. So I don't have data mining. I do believe that Canadian properties are more inflated than US property. Fundamentally, they appear to have a significantly higher level of inflation compared to your GDP growth, compared to incomes. And that is placing basically not a roof, right? A glass ceiling that the properties keep hitting and bouncing back, hitting and bouncing back. So I'll just simply say I'm not an expert, but the fundamentals, when you compare them to prices and you compare that to income and GDP, they don't look good for most Canadian cities. Vancouver, Toronto, Montreal, Ontario, they're not looking good.
Yep, yep. Hence why we've started exploring the U.S. and Alberta. Actually, in Edmonton, Alberta has been another kind of haven of opportunity out there. So we're excited for that as well. So I'd love to learn a little bit more about the current projects that you're working on. I know that you've been really pushing this. What's it called? I wrote down my notes here. Build to rent. Thank you so much. Can you kind of explain to our audience a little bit about that and what you're seeing as the real benefits here?
Yeah. You read stuff, on the web and things like that, and I find that on the web, people are not providing information about fundamental changes, right? I like to chase fundamental change, like catastrophic, fundamental black swan event type of change. So I'm going to describe to you what I consider to be a shocking fundamental change that you may have never heard of. Okay? And so in 2013, 50% of Americans, right, could afford the median priced home. 50%, half of America could afford it. That number dropped the day before COVID to 45%. So it dropped, but it didn't drop that much. 45% of Americans one day before COVID could still afford the median priced home. Today, 4 years later, that number is at 15%, right? So from 45 to 15, basically what this means is a sixth of American families can afford median price homes. And home prices can't fall because of the lock-in effect. My mortgage, I live in a big house, it's $5,000 a month, right? But my interest rate is 1.75%. If I sell my home and buy it back the next day, my mortgage goes from $5,000 a month to $20,000 a month. So I'm locked in. I can't put up my home for sale. I can't leave. Well, 28 million American homes are locked in under 4%, and that lock-in effect means that there's very little inventory in the marketplace, and that puts a ceiling on prices. Not necessarily means that they'll go up, but it puts a ceiling on prices, and it also prevents them from coming down. So it prevents them coming down, it prevents them from going up. So they're sort of in a band, and we've been seeing them in that band for a while. And so if prices can't go down because of the lock-in effect and lack of inventory, we have this shocking scenario where people who one day before COVID would have been able to afford a median price home are now forever renters. So roughly 10 to 15 million well-paid American families cannot buy a home today that could have bought a home before. And they knew that. They knew that they were close, and then their dream was destroyed, right? These are not the renter kind of folks. The renter kind of folks make about $55,000 a year. They know that realistically they can't save up enough for a home, so they're okay living with apartments. These are the 85K income kind of folks. And from the very beginning, their focus has been save, let's save enough for a down payment. And now that dream is gone, right? So when you had that dream for a number of years, when you were that close, you do not want to go to apartments, right? You still want to live in a home. You can't afford to buy one, but you still want to live in one, right? There's not enough single-family rental homes out there, and single-family rentals are very expensive, and still not really available. And then a lot of these single-family homes are really old, right? People don't want to go live in a 50-year, 100-year-old home. So what has happened is fundamental change. Black swan event happens. We go from 50 or 45 to 15% ownership. What happens to that 30% difference, right? They want to live in a home. And so a new class has emerged. It's called built to rent. $76 billion has been invested by institutionals into this marketplace. It's called built to rent. And this is a market where people are building homes, either single family homes or townhomes. And the goal is to build them in communities of 100, 200, 500 homes and rent them out. If it's 500, it probably has all of the amenities. So it has pools and gyms and clubhouses. But the real value is in building them smaller communities of 100, no amenities except a nice central park, maybe a playground, but no expensive amenities, no pools, no gyms, no clubhouses. And people are lapping them up because all along what they wanted was to live in a home. And the definition for these people of a home is so ridiculously simple. I want at least one car garage. I want a backyard no matter how small. And I don't want anybody living above and below me, nobody running in the hallways with the smell of marijuana, no gunshots. I want to live in my own home. And I want to have a driveway in front so I can park the other car, right? It's that simple because that's what a starter home is. No starter home has pools. It never has gyms, right? And these people are trying for a starter home, so their needs are modest. So what I'm doing is I realized that this was a fundamental difference. This was a complete shift. We are not going to go back to where we were before in terms of home ownership. And so I started a separate company. I said, my company, we build apartments, we buy apartments, we do all kinds of different things. We're distracted by lots of interesting things, shiny object syndrome. So I'm going to start a separate company, and I called it Mission 10K, and it's a mission-driven company. So I'm actually taking profits that I'm making on the Grow Capita side and seeing how I can support the second company. And its mission is to build 10,000 rental townhomes because, there are people still doing built to rent single family. I think they're foolish. That train is also gone where the cost is too high to build single family rentals. What is the closest to single family rentals? A townhome, right? Because it's sharing two walls with others, right? And some people are not sharing because they're on the corner of a building, but otherwise it's a single family home. It looks like a single family home. You've got the little backyard, you've got the garage, right? That is the newest, biggest opportunity in real estate because this opportunity was only created by COVID. Before COVID, built to rent existed for a few years and a few people were looking at it. But this black swan event that was COVID has changed everything about the way Americans live, right? So we are fundamentally going to see an enormous increase in built to rent. And built to rent is not, let me say it this way. I think we're going to build about 50,000 built to rent units every year from now onwards. And we're going to build 50,000 less apartments, right? So overall, we're building the same amount of multifamily, but now there's 10% of that is a different kind of multifamily, townhomes, no clubhouses, no gyms, nothing like that, no elevators, and they're going to be built much faster. Single family homes in the United States can be built much, 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 much faster than an apartment complex that needs steel and concrete and elevators, right? So when I build this stuff, essentially what I'm doing is I'm building 6 townhomes, 5 townhomes in a building, and I'm trying to get each building certificate of occupancy individually so that people can move in while the rest of the property is being built. And that's that kind of efficiency you never get with apartments. So I knew I had that efficiency. So I was able to raise $50 million for a company, not for projects, for a company. And I'm using that $50 million to optimize the heck out of that company. And so I think the glorious future are investors who understand what I just said, because this is a true black swan event.
Are you seeing that because as you said, and you already pointed to it, when you're building a single family house right now, the profitability, like I would never think of buying, renovating a single family home and then renting it out because just the rents wouldn't support the amount of capital that it would have taken to get it to that state. Do you find that even with all the townhomes and the efficiencies in terms of the build process and things, do the numbers make like good sense from a cash on cash return?
They don't. BTR construction doesn't make sense. You have to have some uniqueness. You have to have some X factor. Otherwise, they don't make sense. So I'll give you my X factors. Hopefully, other people find their own X factor. So just building a bunch of traditional homes for rent does not make sense. The math doesn't work. So my X factor was that I was able to convince a bunch of investors, patient investors, to give me $50 million. And I used that to do zoning, permitting, entitlement, architectural design, right? And also I built widgets, which reduces my architectural design time. It also reduces my architectural cost, right? So these are townhome widgets, which I fit on pieces of land. So I'm not reinventing, I'm not doing re-architectural work. I can do architectural work for a new project in about 15 days because I'm just fitting existing projects. So I paid for those one time, and I paid for all the zoning and architectural outside of the projects. So what happens is when investors come in, the project is already 18 months old, and they're not paying for any of that 18 months. Got it? Now, going forward, the project is only 4 years long. Now, if you only calculate the returns, which you mentioned, for those 4 years, I know it's cheating, but for those investors, they're only in for 4, then the math works, right? And the previous 18 months, all the risk that have been taken is basically taken by a company that understands that this is the only way we're going to fix the housing problem. And because it's a profit with a purpose company, it takes a hit here. It makes money as a general partner in the 4-year time frame, but it takes the upfront hit. So that is my cheat. Somebody else will have their own cheat, but without a cheat, no, build to rent doesn't work.
So effectively, what your company has done is your company has invested its own capital on the front end to lay out the blueprints, and now you're pulling in investor capital to actually execute on the builds. And in that sense, of course, people don't have to deal with all the site plan approvals and that kind of stuff that goes into these processes.
They don't. They come in when the construction loan closes. We even close the construction loan with our own money, and then we replace that money later. So that's the value of that $50 million. That's what it allows us to do, right? Build a disruptive business model. The investors are happy because they get higher returns with lower risk. They're not involved in the risk phase at all. They never hear about those properties. It's not one of those, well, we are 6 months from zoning. It's like, no, we're 20 days into construction. That's when you're coming in. right? So that's one way of doing it. Other people will find their own ways. The other thing that worked for me is this. I realized this. I cannot chase growth anymore. I have to basically chase NOI. Net operating income is a concept where you basically say, what are my rents minus my expenses? That's NOI, net operating income. I had to give up many of my favorite markets in Florida, in Texas, because the property taxes and insurance are making it much harder to hit net operating income levels in those markets. So I'm chasing markets with low property tax, low insurance, and low cost of construction, low cost of land, right? This means that of the 323 metros in the US, I was only left with 12. Just 12, which had four things: low cost of insurance, low cost of property taxes, low cost of land, low cost of construction. I still needed growth, so I couldn't go into markets that were, losing population. But these markets, some of them are still in the top 10 in the US. Many of them are not. They're in the top 25% in the US. So I had to accept that, right? So not ultra growth, but strong growth. And this is another way that I'm gaming the system. I'm saying I'm simply not going to work in markets, no matter how awesome they are, if their property taxes and insurance are high, because that net operating income unfortunately drives up my rents too much and burdens my tenants. And if it's profit with a purpose, that my mission should be not to burden my tenants, well, then I can only work in 12 markets out of 323.
Fascinating. I love it. Okay, well, this is a good segue into the last kind of component of our podcast here, where I'd like to talk to you just very briefly about legacy. You brought up something very important that your goal of your organization is 10,000 build to rent homes in the next.
Yep, 10,000 rental townhomes in the next 5 years.
Yeah, awesome. So, what do you think of when you think of your legacy and what you hope to kind of pass on?
I'm an immigrant. I know I love this country. I come from another great country, India, and I can tell you, India is a great country. But there's something unique and special about the United States, and it seems like people born here are losing sight of that. There are extraordinarily magical things that happen in the United States. And so I have a dual legacy. One is as an immigrant, I tell people this: you haven't spent enough time in other countries to understand that their flaws are 10x or 100x greater than the flaws of the United States. Yes, we have political polarization in the US, but if you study history, we've had political polarization in the US many times in the last 200 years. It goes up, it goes down, it goes in phases, right? So, and even if political polarization gets worse, our problems are still tiny compared to those of other countries, which have massively greater problems. So I have two missions in life. One is as an immigrant, whenever this question comes up, to point this out to people that are born here that don't fully understand what they have in America. We're losing love for this country, and this should be the most loved country in the world always, right? My second goal is the way I can help my adopted country is 10,000 families are living in properties that are brand new, 9-foot ceilings, granite countertops, and most importantly, their rent is less than 1/3 of their income. So I am not affecting their discretionary income. It's a very difficult goal. It has taken me 5 years to figure out what I just told you. I mean, you got it in 5 minutes. And by the way, anybody that wishes to copy me, please do. Just let me know, because I will count everything that you build towards my goal of 10,000. Right? So feel free. Just copy everything that I want that I do. Go to my website, copy my designs, take it all. Just let me know that if you build 50 units, I'll count those towards my goal, right? If I've inspired you in any way. So to me, those are my twin goals. I feel like, I don't, I haven't logged into a social media account in 10 years, but I can tell you that what goes on in social media, a lot of those people need to spend 6 months, 12 months outside the United States. They will fall in love with their country again.
Yeah, that's very beautifully spoken. Thank you so much for sharing. And that concludes the conversation here. But I really want to push your message, and I want to push the just the value that you just bring to investors, to from an education standpoint. So, what's the best way that people can get in contact with you? What's the best way that people can learn more about you and what you do?
I happen to be the only Neal Bawa on the web, so one of the ways you can do it is just type my name, first name and last name. Everything good and bad you see is about me. There's a website called multifamilyu.com where we gather and publish a large amount of real estate data through a series of entertaining webinars. And we don't just do it about multifamily. There's single family content, there's content about student housing, there's content about artificial intelligence, climate change, anything that we find that is interesting in the world, we try and tie it back to real estate. The content is free. There's no subscription. There's no upsell. There never will be subscriptions or upsells. It is meant to be a Wikipedia of real estate content in an entertaining style. So check out multifamilyu.com. That's www.multifamily followed by the letter u.com, and you'll see a ton of interesting content, including how we use virtual assistants to 10x our business.
I absolutely love it. Neal, thank you so much for your time. As I said, I'm a huge fan, and I really appreciate you taking just a few moments out of your day to speak to me. So thank you so much. My gratitude to you.
Thanks so much for having me, Alex. Have a good one.
You too. All right. Thanks, guys, for joining me on today's episode of the Real Estate Leadership and Legacy Podcast. Don't forget to like and subscribe, and please check out some of our other videos. We've got an abundance out there. We've got a lot of great insight and information, and we'll see you guys on the next one.